Hello everyone and welcome to your on-chain video update for the 8th of August 2021. So this is called Long and Strong. We currently have the market approaching the 200-day moving average, which really is that pivotal moment from technical analysis to just statistical analysis. The 200-day moving average is a really important level because it represents that bull-bear bias, and should BTC reclaim that 200-day moving average, it would be an extremely strong and positive sign moving forward. Now again, we may well lose it, and that would be a bearish sign of rejection, but if we can hold this thing, I mean, so far the market has shown to be pretty strong, and really we want to assess what is the quality of this bounce and what is the probability that this thing is really the start of a bullish trend. So let's jump straight into it. So as we approach the 200-day moving average, what we're going to be looking for on chain are the signs of strength and signs of weakness. We really want to be assessing what is the quality of this rally. There is, with all of these things, there's a good bounce, that's a good chance that we're going to have a pullback, and the market's going to have to rest for a little bit. Consolidation under the 200-day moving average is obviously going to be a good sign. And what I want to do is assess things like the supply squeeze narrative, which is a lot of just look at some of the dynamics that feed into that. We'll look at the miner recovery and the status of where the miners are going and what the overall hash rate and hash ribbons and all of those things are looking like. And we'll touch on our on-chain activity as well, which, as you all know, is an important piece that I've certainly been paying a lot of attention to. So really what we're looking at is what is the quality of the move at the moment? Does it look like we're going to have the momentum to continue to the upside? And is the 200-day moving average just a barrier on the way to the all-time high? Or do we still have some time to chop around in here? So we'll try and look at it from all those different angles. Let's start with Glassnode, and then we'll jump into check on chain later on in the piece. So as of the time of recording this, we're currently sitting about 44,500. I believe the 200-day moving average is about 44,800. So we're certainly getting up to the point where we're contesting with it. We've mentioned in a previous video that our on-chain resistance, or the amount of cost basis that had formed between about 42 and 46.5, was pretty minimal. So what that means, and you can already see we're starting to close in that gap, right? Really rallying up towards the top end of that range. Our next resistance really comes into that 46,000 level, and that's assuming that people start liquidating at that point. Now, as we try to rally into the 200-day moving average, just note that we're seeing our overall derivative volume, our open interest, start to spike higher. And on our funding rate, note that this is actually biased to the positive side. So it's fairly typical as things get pretty exciting that price rallies into a strong resistance level, and we then have a whole bunch of people levering up, thinking that the party simply cannot end. Now, there's every reality that it could carry on, and what this is really just showing is a very strong impulse higher. I do think if we reclaim the 200-day moving average and hold it for a couple of days, then it's basically off to the races. I mean, that's a very, very strong market signal. I'd just be a little bit cautious that we've got building up open interest, but at the moment, I'm not something that's overly terrifying. And really, the longer that this spends at a higher level, it's nothing like what we saw. Let's pull this guy out to a year. It's nothing like we saw during the actual bull market rally, right? You can see how muted it actually is relative to what we saw back in the full bull. So we still have some time to go. Grayscale Premium, note how it started to climb up a little bit, and actually there's a couple of little green snippets down here in terms of our purpose ETF, still dominated by outflows, but not all bad, right? We're starting to see it pick a little bit up. QBTC remains fairly small. I think that there's going to be a product difference between QBTC and the purpose ETF. There seems to be two massive outflows, and this guy's gone pretty quiet. But overall, nothing overly exciting on the institutional front. It's good that it's holding, right? When this is now looking like an uptrend and it's holding a reduced premium on the Grayscale side, that's always a good sign. Let's see if that begins to close up. If that really does close up, that would tell me, particularly now that we have claimed the 200-day moving average, that would suggest a very strong signal from the market. Now, on our exchange balances, because this is always important in terms of understanding the supply and where we're having strength, clearly our BTC and our Ethereum is both remaining very, very strong, right? The volume of coins that are being sucked in and out of exchanges are fairly commensurate, actually. We look at this, we're talking about 100,000 BTC. Ethereum is about, what, 785,000. Previously it was in the millions. Given there's an order of magnitude difference between their prices, right? 48,000 or 40-something thousand, and ETH is at 3,000. It kind of makes sense that they're on about a 10-to-1. So they're both being essentially accumulated at a similar rate. So it really is showing across the board We can see here that both of our we saw a little bit of an uptick in Ethereum balance, but really it's resuming that downtrend, and BTC has clearly held on to this this reduction. So overall, that's a positive sign. We can see that our UTXOs are starting to curl higher. These are showing signs of strength. One has to be fairly constructive on all of this. On the Ethereum side, we're starting to get a little bit of an uptick as we rally higher. You can see that this could look something like a disbelief rally. People are emptying their balance as we're rallying higher. Now that trend is starting to reverse. So it's possible that this is looking more like a disbelief rally than a dead cat bounce. Again, we've got quite some way to go. We've got to work our way back to the all-time high before we can fully confirm it. But obviously, the trend is certainly in play. Active entities is screaming higher, right? We've returned back to where we were pre-crash back here in May. This is excellent. This is good to see. Total transfer volume is up and holding it, which is showing that there remains a fairly, a degree of interest going on. What's quite interesting is that our transaction volume, the number of transactions being sent, transaction count is the correct terminology there. Our transaction count is actually quite low, but what we can see here is on our relative volume breakdown, this dark blue zone are our $10 million plus transactions, and it's currently representing over 50% of the total sending, right? So what we're seeing is fewer transactions, empty mempools, larger value. To me, that speaks of a smart money style accumulation that's going on. Right, total transfer volume for ETH is ticking higher. Active addresses is also, it's higher. It's not blowing your socks off, but it kind of looks similar to what we have across the board. Certainly nothing overly exciting on Aave. We've got transfer volume, Aave Uni Comp, number of transactions on Uniswap, so trades, Aave Uni Comp. Really nothing that overly exciting. Comp looks like it's got a little bit more activity going on. Perhaps Uni is blown out by that peak. I mean, it looks pretty sad, to be honest. There's not a great deal going on. You can see, particularly with number of transactions for Uni on Uniswap, after that peak, right, at $43, it's gone very, very quiet. So right now, this is actually telling me it's probably more likely to be a big cap rally, BTC and ETH leading the pack, which is very common what we see after major drawdowns and the market's kind of recovering its confidence. It will start with the big caps and then flow down. So this seems to be the trend that we're seeing. On the spent output bands, really nothing's overly scaring me here. We're still seeing these older coins remain fairly flat. There's a little bit of an uptick, but nothing that's telling me that they're mass exiting. So overall, this rally remains in a fairly strong. Right? Overall, if we're looking for signs of strength and weakness, it's looking pretty good at this point in time. As we move into our BTC lifespan analysis, we've mentioned in previous videos that we've got on the top here ASOL, dormancy, Coindays destroyed, and then their equivalent that are entity adjusted. So that's removing some of the internal transfers, exchanges using low fee environments to wallet manage, all that. So note that on the entity adjusted versions, all of them continue to break down as we rally higher. So Coindays destroyed, down, dormancy, down, ASOL, flat. Right, so what we're actually seeing here is that older coins are just not on the move. This is what we wanted to see. We didn't want to see old hands spending into the rally, and right now we are not seeing that. So this is actually a very healthy market right now. And again, it's pretty hard to not be constructive at this point in time. On a macro scale, binary Coindays destroyed is actually breaking down, showing that even though we've got a rally going on, we're below average on Coindays destroyed, and liveliness is actually trending down at an accelerating rate, which is even more positive. So for a number of weeks, what we were looking for is on any kind of relief rally, did we get the older hands start distributing and actually exiting? And we're not seeing that. So this is actually building confidence that we could very well have a disbelief style rally on our hands, rather than something that's a little bit more dramatic, like a exit liquidity type sell-off. So overall, that's net positive. I mean, this is just fantastic. Look at the adjusted SOPA and the short term. Short term is even better. This beautiful rally up, pull back down to confidence, and then away it goes. Pull back down to confidence, and then away it goes. So just for those who are not overly familiar with SOPA, the way that SOPA works, when we have these higher peaks, it's showing that profits were realized, and the market essentially had to absorb people selling profitable coins. As we pull back down to a value of 1, what that is suggesting, it's really telling us that the older hands, or the people who have profitable coins, they stopped spending, because otherwise we would have a higher value. So during the pullback, what we actually saw was SOPA reset to 1, which means older coins, profitable coins remain dormant, and then we've returned back into a rally where the coins that are on the move are profitable again. So it's actually showing that conviction returned, people bought the dip, and now we're actually rallying higher. This is almost exactly, this is textbook sticking the landing. So as far as I'm concerned, if this particular market structure holds and we continue to rally higher on our SOPA value and we don't break down below 1 and hold it there, to me, this is the quintessential example of sticking the landing. It's looking very, very positive at this point in time across both the all market and short-term holders, which is really what you want to see. Realized profits continuing to really break down. This is on a median, so it's giving us a bit of a what's the typical behavior after we saw that big profitability spike back here. Loss-making coins continue to be spent, but really this is overall a very, very big good picture. We're not seeing anything here that's overly negative, and actually I think everything here is quite constructive on price. So it looks like we're going to stick the landing. Now on the mining front, so what's important about the miners is obviously they're going through this great migration. What we want to see is miners coming back online. Now, in previous market cycles, when you see the hash rate start to tick higher, so for example, after a major decline, normally this is price driven, and then we have miners coming back online. That's actually suggesting that difficulty is going to wind up higher, people are going to become less profitable, and they're going to have to sell more coins. Now, in this particular circumstance, I actually don't believe that those mechanics necessarily have to hold. Now, the reason is because there's such a shortage on ASICs being manufactured at the moment globally that prices currently, like we should be seeing hash rate doubling in order to offset just the fact that we've had price rise from 10,000, let's say, is the average price through the entire bear market in 2018 through to 2020, right? 10,000 was kind of that middle ground. ASICs at the moment are currently the operational fleet of ASICs is essentially capturing a price down at 10,000. So now that we're up at 30,000 or 40,000, what we're actually seeing is that there's no new ASICs coming to market. So anybody who's got an ASIC, and even S9s, which are actually obsolete models, are currently profitable. So there's literally not the ability, there's no elasticity in the hardware manufacturing to offset the rise in prices because of the global supply chain shortages. So what this means in our current context is that when rigs are coming back online, it actually means that the miners who are offline in China are returning to profitability. Maybe they've shipped their rigs somewhere else, maybe they've relocated them, maybe they're secretly mining somewhere, who knows? There's all sorts of operations. But the fact is that their income is coming back on. And when their income comes back on, it means less miners are in stress. And basically, if every single ASIC that was operational back in April was turned back on tomorrow, they would all still be amazingly profitable because the price has rallied, but no competition has come back to the market. So what we're actually seeing is a recovery in hash rate and a recovery in our difficulty ribbon starting to curl back around. This is actually very bullish because what we're doing is removing, yes, sure, some of the miners get a little bit less profitable, but we're removing miners from the system who are currently earning no income, right? And if they're earning no income, they're more likely to sell their treasury. So it's actually more beneficial for price for hash rate to recover in this instance, which is actually unique. We've not seen this market dynamic, and it's simply because hardware is inelastic relative to price at this current point in time. So we can see that the balance in miner wallets, it's basically in this beautiful uptrend. I mean, this whole sell-off, they've just continued to accumulate, right? We've stayed green and actually accelerating. So really, there's nothing telling me that the mining recovery is exerting undue sell pressure at the moment, and in fact, quite the opposite. It seems to be quite sustained, sustainable is probably the right word. Miners seem to be coming back online. What are we up here? This is almost 125 exahash. We were at 180, so we're closing the gap. 70 exahash left, and we'll pretty much be back to all-time highs. So this is overall a net positive. Now, there's been a lot of talk about the concept of a supply squeeze, and we've mentioned in previous videos and previous sessions that it's likely that it can take some time. And we're also going to start seeing the impact of how many coins were sold up here in this top zone, because I think 6 months ago, if we're in August now, we're talking about March, and soon we're going to be talking about April. So this is a zone where people, if they did liquidate down during the last 2.5 months, they're the people who likely sold. Now, what we can actually see here, let's actually zoom in on this guy because I think this is important. Note how our long-term holder supply is just like a rocket ship flying up, and we're almost getting to the point of call it the supply squeeze zone, which was about, what is this, 12,500, I think, 12.5 million, sorry. I think this is something on the order of about 70% or 75%, if I'm not mistaken. Might even be 80% of the total coin supply. You can see that we're pretty close, right? We're getting up into this zone that previously caused that supply squeeze. Short-term holders is just rocketing down. But note here how we saw this uptick in red. Then we've seen that dark red, which is 1 day, shift to this guy. Offset by 1 week, that has now swelled into this orange band. This is coin maturation, right? So actually, let me zoom in so you can see this even closer. These successive peaks are offset by the minimum age bracket for each of these waves, right? So this is 1 day. After 1 day, it's going to move to this light red zone. After 1 week, it's going to move to this orange zone. This is now 1 week to 1 month. So in a month's time, if the coins that were sold here, they're maturing right now. Those coins are maturing. So somebody accumulated those coins and put them into cold storage. So coin maturation is particularly good, particularly when you're looking at coins that were accumulated down here in this zone. So overall, this is a net positive. We're starting to see good signs that there are coins that were accumulated and put into cold storage. Our loss-making and profitable coins for long-term holders is continuing to trend higher. Overall, this is looking very good. So our supply squeeze narrative is actually looking like it's got some serious legs in play. Again, we'll see as the long-term holder supply really starts to reach this April and particularly May zone. As we formed this topping pattern, we will see the behavior of this long-term holder supply, and the way that it changes and reacts is going to tell us a lot about what kind of coin supply was actually sold. We know there's about 140,000 that flowed into exchanges. We're going to get to see what kind of age brackets, when were they sold, when did they come from, and to what magnitude. So I do suspect that we're going to see a bit of a slowdown. Note how we had a bit of a slowdown here before the supply squeeze really took hold. It's probably going to look something like this, where it starts to really chop around for a little bit, form a bit of a topping pattern. The market consolidates somewhere. It'll probably correlate with a technical analysis level, and traders will start saying, look, it's a lower high, and then the thing will rip higher. So it's likely to show up as some kind of behavior similar to that. But really, the magnitude of this line, where were we? This is 10.9 million coins back in April, and we're now at 12.5, right? So that's what? 2.5 or 2.6 million coins that were accumulated. When was this? This is in April, so 6 months ago. So 2.6 million coins were accumulated between, say, December or November and March. That just shows the magnitude of what's going on, right? There's just a fundamentally huge amount of supply. And I mean, it's enough to actually bring this thing back to where we were previously, right? So the supply squeeze narrative certainly has legs. I'm personally not one who's going to be betting against it. To me, it seems like the most plausible option. And particularly when you look at all of our strength metrics above, none of the old hands are spending. We're not seeing the exit liquidity moves that we've seen in the past. Or that we were expecting at least. And what we're basically seeing is illiquid supply chain still looks pretty good. Long-term hold and net position change, it's all looking very, very strong. So if we're looking for strengths of weakness, really it remains in the only bearish thing that I can see is the on-chain activity side. So I actually want to jump to check on-chain, and we'll explore that in a little bit more detail. Okay, so where I want to start with this, I actually want to start with our Magic Lines full history. Magic Lines is basically looking at Bitcoin's, the moving averages that are shown to be support and resistance through bull and bear markets. Now, what we have here is our 128 and 200 daily and weekly moving averages. So 4 lines, 2 periods, and one's in the daily basis, one's in the weekly basis. So if we look at our weekly basis metrics, let's take it at realized price as well. Weeklies really catch bottoms, right? So the 200 weekly catches the absolute very bottom of a capitulation move. We can see that it caught March 2020. It caught our bear market back here in 2018. And our 128 week forms that kind of similar to the realized price. Let's put our realized price back on. It shows us when we've entered the capitulation zone, right? It picked up all of these capitulation points. These are bottoming metrics, right? Metrics that will catch the bottom of all these markets. If we now jump to our 128 and our 200 day, now these metrics, these moving moving averages have really shown to be strong support, with the 200 being kind of the long-term bull bear. When we're below the 200-day moving average, it's a bear market. When we're above, we tend to stick the landing and it's a bull market. When we're below, it's a bear. When we're above, it's a bull. Now, the 128 is kind of that acceleration phase. So I actually liked the 2017 market as an example. So we've got our 128 in purple. So note how in the bear market, the 200-day provides resistance and then the 128 steps in. Until we break the 200-day, 200-day forms support, and then once we start to accelerate into the full bull, so this is kind of the disbelief bull, the first leg is where the 200-day steps in as support. Then once we get momentum, note how we stop returning to the blue and we only return to the 128. So the 128 provides support all the way up to the top. So if we now pull across to our current market cycle, we can see the same. We found resistance on the 128, then the 200-day, then the 200-day, and then the 128 took over. We broke above the 200-day, which signaled that we moved back into a bull market. We had a 2019 kind of mini bull bear cycle where it actually repeated many of the same things, found resistance on the 200, found resistance on the 128, and then it took over. We had our disbelief phase after the March 2020 sell-off, where we used the 200-day as support, and since then we've essentially been in free rally, right? So you can actually see how we never returned to the 128 in the late stage of 2017. We actually went through that whole thing in 2021, right? And I think we all agree that the rate of change and the pace to the upside was pretty immense during that first phase. Now, what's quite interesting is we are currently above the 128, so we have made that first move. You can see that we contested the double whammy on a few instances. We were rejected back here in 2019, rejected in 2019, and then we reclaimed it back here in 2020. We're currently above the 128, which is at 43.1, and 44.87 is our 200. So as you can see, I mean, this is a pretty strong move off the bottom. If we can get above and hold it, we've essentially claimed the 128. The 200 is kind of the last line of defense. And really, once we do that, I would certainly suspect some kind of disbelief retest, right? Come back and just confirm that that 200-day is going to hold. And really, that's going to be a generational buying level. If this thing does start to move, that to me is just it makes a lot of sense. Now, conversely, if we're here in this 2019 type system, if we get above, this was a good example, we got above and then we lost it. So it can get pretty dramatic to the downside. And actually, I kind of suspect that something like that could happen, even if it's just as a flush. I think we're going to get some volatility around the 200-day moving average, whether to the upside and the thing just goes into full FOMO, or we're going to get a reclaim, it's going to fall below, scare some people, and then away it goes. So I am expecting some volatility around the 200-day. And the reason that works is because so many people are looking at it. It's such an obvious level to go short, to go long, to go all manner of leverage. We saw that our open interest is picking up. So I strongly suspect we're going to get some kind of moves. And it could very well be what we're going to look back at in a couple of weeks is go, yes, it really did confirm it. It retested it and then away it went. It sliced through and it just carried on, or we got a very, very tentative rejection. So we'll see how this plays out, but I'm certainly expecting volatility in and around these levels. Now, what I would like to look at is our activity, because I think activity is an important one. It's the last thing that we're kind of waiting on to really start to pick up and show some strength. So very, very high level, our NVT and our RVT, which are kind of our activity relative to market valuation, we really did lose our bull zone, particularly on the RVT, right? We've lost it almost completely. We can see that our activity metric is starting to curl up. So that's at 27,000 and 38,000 for our 90-day. So on an activity basis, noting that there's a 28-day and a 90-day lag in all of these things, we are technically overvalued. But again, we sometimes see this disbelief phase, right? We need to see whether our price is going to rally and that brings in the volume. Or if we are truly in a disbelief phase, we just have to continue to break north. So generally when we break out, let's actually turn off our NVTs. Because I like the RVT because it's just on-chain to on-chain. It takes out the noise of both sides of the equation. Note that the RVT is kind of a very cyclical oscillator, right? It's in the bearish territory and then it's in the bullish territory. It's in the bearish territory, then it's in the bullish territory. So it tends to waver between these two. Right now, I mean, we're somewhat similar to 2019. You can see that we tousled around in this orange zone for some time. This is kind of this indecision phase. Kind of looks a little bit like that. A strong reversal to the downside here would actually be pretty bullish. One thing we're going to get is our RVT starting to tick higher as coins are moved on chain and revalued. So that's going to improve things as the realized price rises. That in theory should help correct our RVT ratio. But we will see. Ultimately, a lot of this is being driven by the transaction volume. And if we jump to our transaction volume chart, we do have a bit of life springing back in. But you can see that we're still kind of trading around. Let's pull our price down, or our market cap, I should say. So really our current level is where we were back here in January, February. So in theory, it's showing an upwards momentum. It's climbing. This is certainly a rally off the bottom, positive to see. Really, like our SOPR metric, we want to see this rally, pull back, and really stick the landing. So if we get a real flush and a whole lot of volume come in, even if it's on low transaction count, that's not a bad thing, because overall that's saying that smart money is stepping in size, particularly if we claim the 200-day. This is the kind of confluence that we're looking for. On-chain activity starting to pick up in volume, not necessarily in transaction counts and mempool space. I would treat volume as more significant because that's smart money accumulation, big money, and we need big money to push us higher. A reclaim of the 200 and on-chain volume starting to pick up would both be a strong confluence that we're going to carry on. We can see here on our transaction counts that we're actually still, on a relative basis, still very, very low. Let's pull this back. I think if we actually measure this out, we're actually down here near where our capitulation zone is, right? So we're currently down here at 230,000 transactions a day. Last time we were there is realistically back here at the capitulation point. So, this is really showing the magnitude where we are. This is a very, very quiet market back here. But also note that this had started recovering, right? People were starting to move back into the system as the bear market wore on. We had this increase in transaction volume. We're starting to see this reversal back to the upside, which would actually put us somewhere in here, or it could actually be we saw back here in 2017, actually. This was around the Bcash hard fork, where we essentially had a serious sell-off, right? That scared everyone. I think this is about a 50% decline. And there was two of them back to back. We saw a decline in transaction counts down to a similar level. So perhaps we're seeing this fractal. This was fork FUD. This was energy FUD. Maybe we're seeing the same fractal start to play out. Maybe it looks something similar to this bearish market here. It kind of remains to be seen, but again, low transaction count, but screaming higher transaction volume, starting to smell a little bit more like smart money accumulation, particularly when you combine it with lifespan metrics looking very, very positive, SOPA looking very positive. The market's clearly absorbing profits. A big risk is that all of this is happening on exchanges rather than on chain and people actually withdrawing. Call it the breadth of the market. What you kind of want is lots of people accumulating, a very large cross-section of buyers. If we start to see that transaction count trending higher, we see volume trending higher, that's all just going to be confirmation. So, we've talked about me being, I've kind of tipped from that 50-50 when we were down at 29,000, whether it's going to go up or down. We then shifted to a 60-40 to the upside. We're now starting to look more like a 75 to the upside. If we start to claim that 200-day moving average and we stick it and we hold it, it's really looking very, very positive, right? And the longer that we hold that 200-day and trade above it, the more probable that we're going back to all-time high. So, the recovery is strong. It's pretty hard to find a bearish case at the moment. And I just want to introduce, I know I've mentioned coin maturation. Let's look at the 60-day. I introduced this new metric here, old and young coin supply. So this is basically the poor man's long-term holder, short-term holder supply. Again, this is using Coinmetrics community API. And what I've basically done here is summed all of the coins that are older than 6 months. Right, so it's the poor man's long-term holder supply, but we've got old coins here in green, young coins here in orange. We've got our adjusted supply or free float supply, which is taking into account all the coins that are assumed to be lost. And then we've got obviously our circulating supply. So you can see the magnitude of coins that are actually lost. We're down here at 14.5 million. That's actually in free float. And of that, 11 million. So of the 14.6, we've got 11 of those that are long-term holder coins. And the remaining 5.8 are young coins. And remember, a good chunk of those are going to be on exchange balances, and they're currently in the process of depleting. And we're probably going to see, once we get 5 months away from our current consolidation range, we're actually going to start to see this probably declining, because I'm pretty confident that a very large volume of coins have been accumulated down here at this 30,000 level. Most of us didn't think that we'd get such a gift, but the market was kind of that way. So overall, it's looking pretty good in terms of signs of strength and weakness. There's far more signs of strength right now. Things that could make us undone is if people get too leveraged and we see open interest just screaming higher and everyone goes super long at resistance. That's probably something that would trigger some kind of squeeze. But I am in the camp where I think that spot markets are going to drive things at the moment. Sure, we're going to get some intraday volatility because of liquidations and open interest and leverage. But my gut feel is that we've got a spot-driven rally going on at the moment. And, quite frankly, the market has continued to rally against the on-chain volumes and things being low. So at this point in time, it looks like a disbelief rather than a bearish relief rally. We're not seeing old coin spending. It actually looks nothing like what we saw in 2017, 2018. In fact, let's just close on that last note. Let's just jump across to spent output age bands. Now, what I really did not want to see, let's turn off all of these young coins. Let's keep everything to 1 year plus. What I really didn't want to see on our relief rally is something like this, right? This is just mass fear. This is mass exit of all the old hands, right? This is a capitulation. These are people going, oh man, that was an ugly top, I'm getting out. That's a relief rally with people saying you're getting out. And note how they didn't sell on the way down, but they did on the relief. Right now, we're just not seeing anything even remotely close to that, right? A couple of old coins moving, but see these individual spikes, that's really not something that I'm too concerned about. Let's put on a 7-day median. And we'll have to turn off these younger coins. But ultimately, what I'm seeing here is net positive because very, very little in uptick, right? This is nothing close to a mass exit. It looks nothing like what we saw in 2018, just the sheer magnitude of difference here. And remember that this is during a period of very quiet mempools. When you've got a very quiet mempool, it shows you the real signal because there's not all the daily transactions flowing around. It's not noisy. You're seeing only who really wants to get out, and we're just not seeing it. So at the moment, disbelief rally, signs of strength, overall net positive. Let's claim that 200-day moving average. If we do happen to claim it and hold it, to me, it looks like it's off to the races. And if we do claim that, you'll see my slides change from blue to green because that would be essentially my trigger to say that the bull market has resumed and the on-chain analysts are right all along. Thanks for tuning in, everyone. As always, you can grab me in comments and chat rooms, and I will catch you in the next video. Cheers.